So we're probably wondering at this point, what's depreciation? Depreciation, uh, let's say we have a truck that we've bought for $32,000. A lot of things we buy, when we get them, we go, oh, truck, we expense them the first year that we bought them. So we might go, you know, truck expense, and that would all be written off on the income statement. We go truck expense and cash, $32,000. But that really wouldn't tell our books the real story about that truck. That truck is going to last more than this year. So what we're going to do is, say the truck lasts 4 years instead of just 1 year, instead of taking all of the expense in year one, you know, year one, year two, we would take some of that expense in year one, some in year two, some in year three, and some in year four. In other words, we would allocate the cost over the useful life of the truck, taking some of the expense every year. As you will see as we go into the next section on this, it has to be done in a rational and systematic manner. You can't just say, oh, we'll take, you know, $2 this year and $4,000 the next year. It has to be a rational and systematic manner that in some way makes sense. We'll look at 3 different methods for doing that: straight line, units of activity, and double declining balance. When we're figuring out how to allocate this cost, there's 3 different factors that we'll consider. One is the cost of the truck, or the asset. This is for our plant assets, the cost of the truck. And that's going to be a fairly solid amount. We paid for the truck, we got the lettering done, we did all of that good stuff. So we have the cost. We have to estimate the useful life. How long is the truck going to last? Well, most of the time our trucks last 4 years, so that's probably a good estimate. Salvage value. How much are we going to get for the truck when we're done with it and we try to sell it to somebody else? The salvage value, again, these are both going to be estimates. And at this point, they will be given to you. You don't have to figure out what they are, but you need to be aware that they are, in fact, estimates. Okay, what assets get depreciated? It's going to be our basically machinery and equipment, because it wears out, buildings, and land improvements. What does not get depreciated is land. So of our plant assets, we can depreciate land improvements, buildings, and our machinery and equipment. Let's see. One way of conceptually looking at this to understand what we're doing here is to think of the truck as a, this is going back to the beginning here, as kind of a giant prepaid expense. And if we look at other types of prepaid expenses, when we do, say we had the prepaid expense supplies. In other words, when you buy the supplies and you put them into the supply closet, you've got an asset supplies that is going to get used up over time. And every period you make an adjusting entry to say how much of those supplies you used up. And so you go supplies expense. Okay, and if you used up 1,000 of those supplies, you would debit supplies expense. We used up that many, and you would credit the supplies account to show how much had been used up. When we're depreciating our assets, it's done in a little different way. We're going to want to keep the truck on the books. And so as we allocate the cost over its useful life, we're not going to, we have the truck on for 32 here, we're not going to reduce it by reducing the truck account. What we're going to do is use a companion account that goes with it, which we properly call a contra account, and we're going to call that accumulated depreciation. Accumulated. And you'll see more about this later. I just want to show you what it is trying to accomplish. So you've got accumulated depreciation. So say we were taking, what did I say, 4 times? Say we were taking 8,000 on the truck each year as depreciation expense, we would still need our depreciation expense just as you needed the supplies expense account. And just say we were taking $8,000 a year, we would do the credit rather than to truck. We would use this accumulated depreciation account. And so when we report the truck on the books, truck less accumulated depreciation of $8,000 would give us its book value. So it accomplishes the same thing, except you're using two accounts together rather than just reducing the asset account itself. So anyway, that answers the question, I hope, of what is depreciation, and your next move is on to figuring out how to compute it.